Stamatis, very good to have you here today. Just a quick recap in addition to what Andrew said. So Seanergy is listed on the NASDAQ. You have a market cap of about $250 million. You're a pure play Cape operator. I guess you also have one newscastle at Max. And you're very much focused on that sector. And it would be very interesting to hear your views on the market, but also how you intend to take Seanergy to the next level. But maybe we can start a little bit with yourself. You have a very impressive history working with investment banking and then later on the industry side of shipping. Can you tell me a little bit about your background and also what your focus has been as CEO of Seanergy?
Well, good morning, everyone, and big thanks to Marine Money for hosting me here today. As a matter of coincidence, my career started in 1998 as an investment banker, and coincidentally at the Marine Money of, I think it was 99 or 2000, that was the Marine Money that the wave of public listed companies in the New York Stock Exchanges happened. It was the day where we presented as Alpha Finance back then, and Stelmar Shipping, the first international shipping company to list on the on the New York Stock Exchange, approached us. And that's how the big wave of the shipping IPOs started. So we listed Stelmar Shipping as a banker. I was a junior banker at the time in 2001. Thanks to Marine Money and thanks to the conference that they did in Athens back in the day where we presented capital markets. Of course, back in the day we were talking about the Greek capital markets that were on fire at the time, but that became pretty much soon obsolete. And then we chose to go to the bigger market that was the New York Stock Exchange. So throughout my career, from the beginning of the 2000s until I joined Seanergy in 2012, I've been very active in raising a lot of capital, either as a banker or as a CFO of a public company. So we have a very big experience in going through all the phases of the US capital markets throughout the years. And I'm happy the way that things have turned out right now. I mean, we've had a lot of hits and misses. There were a lot of companies that didn't make it and they didn't survive as public entities. But right now, I believe that what has been left in the US capital markets appear to be quite robust with good balance sheets, and they appear to be there to live for the next phases of shipping.
Thank you. Can you tell us a little bit more about your business model, both when it comes to your customer focus and which trade routes you focus on, also what you do in-house and what you outsource?
Of course. When I joined Seanergy in 2012, it was not a matter of choice, it was a matter of survival. I remind everyone that that was the second wave of the over-ordering. There were like hundreds and hundreds of ships being ordered with the private equity money. And what was the tail of all this additional surplus of capital that we saw with the US capital markets and all the banks lending a lot of capital. So when I joined Seanergy, I mean, the company was entering into a restructuring phase. And it was one of the options considered back in 2012 was, filing for Chapter 11, which was very much in fashion at the time. I remind the audience that many companies went through this phase. I mean, some of these companies exist today, some of these companies do not exist today. So it was pretty much a matter of survival. So we had to unwind all the debt instruments of the company. We had to sell all of our ships, and we had to rebuild our fleet. So from 2012 until 2014, we basically sold all of our assets, we unwound all of our debt, and we decided in 2015 to get in what we consider to be the Champions League of the dry bulk market, and that was the Capesizes, because it was a great entry point. We bought our first ship quite, inexpensively, to put it this way. And then we had a perfect entry point to start rebuilding our fleet at close to historical lows. And that's how we did it. I mean, initially it was not a choice, it was a matter of survival. And then it became a strong choice because we believed it was a great thing to be in the Capesize market, and we wanted to consolidate the space as much as we could. So that's how we built Seanergy, and today we are two companies listed, it's Seanergy and United Maritime. Combined, the two companies, they have 28 ships, 23 of which are Capesize and Newcastlemax. So that's quite a sizable fleet, to be a pure play company listed on the capital markets.
Absolutely. It's interesting what you're telling us. Can you tell us what was the key learning from that sort of near-death experience that you went through back then? What are you doing differently, based on that experience?
Well, there are so many things that we do differently. I mean, I joined Seanergy and it was already in a pretty bad shape back in the day. So it was a completely overhauling of the company, to put it this way. So what I wouldn't do again is, I believe the supermarket approach, owning too many different vessel types, is distracting. I don't think it adds a lot of value because you have the same company resources dealing with so many different ship types that I don't believe it's sustainable. And they appear to be the same, but ultimately they're not the same. Of course, the capital structure. I mean, we wouldn't go again to 100% leverage or more than 100% leverage because that's unsustainable. And when the bad times come, you cannot really survive when you have a debt overhang for no reason. I mean, and size is not, in my opinion, size is a utopia. So unless you have this crazy feeling that you want to rule the world or things like that, there's absolutely no point in deceiving yourself and investors that owning 200, 300, 500 ships actually makes any difference. As you can see, most of the public listed companies, they have pretty much similar and comparable figures as far as revenues are concerned. Expenses are pretty much the same. Cost of capital is pretty much the same. So, you have marginal differences. And, when you build such a big fleet from a boutique store, from a Gucci or from Hermes, you become like a supermarket. we like the boutique approach, to put it this way.
Very good. Thank you for that. So you have been overseeing a very impressive amount of acquisitions. I think the number is $660 million, if I remember correctly. As CEO, can you tell us a little bit about the key transactions that you've done and what the focus has been in terms of building the company?
Well, yeah. I mean, we had a critical mass up until the COVID time came in 2020. So we had 10 Capesize at the time. So there comes a point where you have to pick and choose where you need to go bold. And, in June of 2020, we decided that it was time, just when the world was predicted to be finished and everybody was going to die from the pandemic and all that, we decided and we chose to be bold and aggressive in our acquisitions. But that was not like a crazy feeling that we had. When you look at the asset values to be close to the historical lows, I mean, we bought a ship in the summer of a Capesize ship. In the summer of 2020 for less than $11 million. The same ship, like a year and a half afterwards, was like double the money. So there are certain decisions that if you take out the noise, the outside noise, whatever that noise may be, there are certain decisions that are like a no-brainer decisions. You just have to move on and do it. So I believe that the key turning point for the company was immediately after the COVID period where we decided to be very aggressive in our acquisitions. And we said, now it's the time to bulk up, to increase our size and become, I'm not going to say dominant player because no one is a dominant player, but to become a prominent player in the Capesize market.
Thank you for that. So looking ahead, I mean, there's some discussion now around dry bulk. Our vessel value is too high compared to the earnings potential. Some people say yes, some people say no. What do you think yourself? Is now a good time to buy more assets?
Well, there are actually three things. One is buy, second is sell, and the third one is hold.
Absolutely.
We have bought a lot of ships, so we're in very good size. Seanergy will have a size of about 20 vessels, all Capesize and Newcastle Maxes. I believe that for the share capital, the share count that we have, and the amount of cash flow that these ships will generate over the next few years, I think it's a great hold opportunity for people that have bought our shares. They indirectly participate in a great fleet of Capesizes that are predicted and expected to make a lot of money from cash flow in the next few years. I mean, we have about 20 million shares outstanding, and if, for example, the company can make 50 million of free cash flow or 60 million of free cash flow, that's like $3 a share. It's a crazy return on investment, And okay, we're not Google or we're not Microsoft, but for a capital-intensive industry that we operate, I believe that's a very, very strong return, on investment.
Agreed. You're a pioneer when it comes to alternative fuels and sort of future weathering your fleet. Can you tell us a little bit about the motivation for that effort? And obviously, it's good for the environment, but does it also make sense from an economical point of view?
Well, that's a great question. We never ever wanted to become, let's say, the guinea pig of the alternative fuels. I believe that it's a wrong idea and it's a wrong move. At the end of the day, dry bulk is a very, traditional form of shipping. So there's absolutely no need to try and reinvent the wheel and say that, these traditional assets will be converting into ammonia or hydrogen or something in the future that, in my opinion, may not be sustainable from a financial point of view. So until we see a solution that is proven and is working and it applies on, I'm not going to say the vast majority of the 13,000, dry bulk ships, but applies on the vast majority of the vessels, we're not going to move into that. However, since 2015, we have decided, and we have been very successful, in making the existing vessels way more economical. So instead of doing, crazy modifications or things like that, we started experimenting on things that are proven, like Bosch-Cap fins, like Mevis ducts. The biggest saver has been the silicone paints. Silicone paints alone have been contributing to more than 8 to 10% of improvement in speed and consumption. So why go crazy in things that are uncertain? They cost a lot of money, and you never know how these things will play out when you can actually do existing proven solutions and be absolutely fine. So right now, we will not do anything in respect of crazy innovation, to put it this way, because not only they don't make sense financially, but also I don't believe that our crew members have the sophistication to operate the alternative fuels safely. That's why we're going to stick to proven solutions. We're very happy with that, and we will continue to expand our fleet with standard-based ships that we will be upgrading with proven solutions.
Thank you. Maybe we can move on to talk about the market. Our own analyst in DNB downgraded dry bulk recently. I'm not sure if I agree myself, but that's what he says. So there's some mixed opinions when it comes to the outlook for dry bulk at the moment, and also some question marks around the impact of China. What's your take on the market going forward?
Well, obviously, I must say that I am very bullish, but I'm very bullish as far as Capesizes and the ore carriers are concerned. China has been in question for like 2 years now. You had the bankruptcies of Evergrande, you have all these skeleton, construction facilities remaining the way that they are. So I think that the China slowdown story has already played out. I must remind the audience that China is building 56% of the global steel production, and it's exporting its steel. So no matter wherever in the world you have a construction, you will need steel. So who's going to build that? You don't see any new blast furnace factories being built in Europe or the United States or whatever. Steel has to come from somewhere. And the biggest producer is China. So no matter what happens, wherever in the world you have infrastructure, like, for example, the Middle East, like America, like Africa, like all these places, Asia, you need steel. So yes, China may be slowing down as an economy, and it's kind of expected. You cannot, have this mammoth economy growing at 10 or 12% a year, but, they produce a required element for the global infrastructure, and that's steel. And if you see, in a year where you had all these bankruptcies of real estate, especially like 2023, Chinese iron ore imports were up, Chinese coal imports were up, bauxite imports were up, and finished steel products exports were also up. So, something's working quite well, and we're very happy with that. But the most important element about the market is not demand. Demand is pretty much stable, and we're not concerned about demand. It's the supply. The Capesize market has the lowest order book of the last 25 years. And the fleet is getting older and older. So it's not that you have a young fleet and zero order book, it's that you have an aging fleet, which is well into the middle age, of the useful life. And at the same time, you have zero new buildings, very low new buildings. It's almost impossible to find any second-hand acquisitions of Capesizes that have been built post-2015. So, in my opinion, it's kind of a no-brainer. If supply is getting, lower and demand is pretty much stable, I don't really see any issues unless someone goes crazy and starts ordering ships, which will not be delivered before 2027, 2028. So I don't really see any material risk from supply arising from the next 2 years at least.
I totally agree with you when it comes to the order book in particular, and also tend to be more bullish than our research analyst, as I mentioned earlier. When it comes to the different segments of dry bulk, obviously you're doing the larger vessels. Where do you think, where do you see the most potential, between handy, mid-sized, the larger bulkers? And I know you're in larger bulkers, but try to be objective. So I would be interested to hear your views on that.
Well, that's a great question, and we have spent hours and hours internally trying to assess what we believe to be the best investment opportunity in dry bulk. In our second company, United Maritime, we own Kamsarmaxes, and we're very happy with this investment so far. The problem with smaller sizes is that the barriers of entry are not as high as in Capesizes, both from an economic point of view as well as an operating point of view. I mean, anybody operating in shipping can basically go and put an order for Supramaxes, Ultramaxes, or Kamsarmaxes. It's not the same for Capes. For Capes, you need way bigger capital, and you need access to the miners. So it's kind of impossible for someone that is kind of green in shipping to decide and get into the Capes. So since we have consolidated the company and geared it up into this kind of a level, why, let's say, dilute our story and get into something that we believe that we will not add any real value? I mean, there's so many companies, saying that they add value in handy sizes, Supramax, Ultramaxes, and I totally agree. But I don't think that we can add value into that size. But we do add a lot of value, and that is pretty much evident with our financial results. We have one of the highest rates from all the public companies that are in dry bulk. So we add value to that, and we will stick to that.
Thank you. Thank you, Stamatis, for joining us today. It was a pleasure.
It's a great pleasure. Thank you for having me. Thank you.